Hey everyone, today I'm going to cover a type of problem related to dividends that you would typically see when you get to the equity section in an introductory financial accounting course. So this is related to dividends that are paid out when you have preferred stock and common stock. So when you have both types of stock on hand, preferred stock always gets a preference over the dividends that are declared. So if a company declares $100,000 in dividends, and preferred stock is guaranteed 60,000 of those dividends, they will always get paid before any common shareholders get any payments. So they're always first in line. So they're guaranteed their $60,000 no matter what. And then common shareholders get the remaining, which in that case would be 40,000. But say they declared $1 million in dividends, preferred shareholders still are only guaranteed their 60,000. The remaining amount, anything over that, so the $1 million minus your 60,000, the 940,000 would be guaranteed to the common shareholders. So early on in a company, it might be better to have preferred stock because you get your guaranteed payments. But later on, it might be better to be a common shareholder. So there might be something called a convertible stock that you could invest in if you wanted to initially. But that's another video, so I'm not going to get into that right now. This particular problem I'm going to go over relates to cumulative preferred stock. So if you have a problem related to non-cumulative preferred stock, it would vary slightly because you wouldn't have any dividends in arrears, so you're going to want to review that problem separately. So this problem is dealing with cumulative preferred stock. So what cumulative preferred stock means that if a company declares their dividends for the year, and the preferred stockholders say are supposed to get their $60,000 in dividends, but the board of directors only declared $50,000 in dividends that year, which means it's not going to cover the full $60,000 payment to their preferred shareholders. So that $10,000 would go into something called in arrears. So what that means, it's basically like setting aside that money for the future. So if it's cumulative, that $10,000 will roll over to next year and get paid out before any current payment goes to their preferred shareholders or their common shareholders. So that will get paid first, and then the current year's stock or dividends will get paid to preferred and common after that. So it just rolls over, it accumulates over time, which is called as cumulative preferred stock. Okay, so let's get into this particular problem. So Omeyer Corp has stock outstanding as follows. So they have cumulative preferred stock. They have 60,000 shares outstanding. They're supposed to get a 3% dividend with a $20 par value. Our common stock, there is 405,000 shares outstanding. It has a par value of $25. And then the board of directors distributed 1, 2, 3, and 4th year, the various amounts each year in dividends. So let's go ahead and determine the dividends per share on each class of stock for those 4 different years. All right. So first thing I want to do is I'm going to go off to the side and do a calculation for my preferred stock, because I want to figure out how much dividends are supposed to get paid to my preferred stockholders every single year. So the first thing I want to do is figure out the dividend per share that they are supposed to get paid. So take your par value, multiply it by the 3% dividend rate. They are supposed to get 60 cents per share every single year that they hold that preferred stock. All right, in total, it's going to be your dividends per share times the number of shares outstanding. In this case is 60,000. So we are supposed to pay out $36,000. We, as an Omeyer Corp, is supposed to pay out $36,000 of dividends to our preferred shareholders every single year. So let's go ahead and do our calculations. In the first year, we declared $32,000 in dividends. You can already see that's going to be a problem because we are supposed to pay out $36,000. So that is the amount we're supposed to pay out. So I'm going to put that in here. I'm going to end up with dividends in arrears. So it's the difference between our 36 and our 32, which is $4,000. So the total preferred dividends that were paid out is 36 minus our dividends in arrears, gives us 32,000. We didn't have any dividends in arrears that were paid out this year, especially because we ended up with some more over here, but it didn't say we had anything in arrears from previous years. So total preferred dividends was $32,000 this year. Our preferred shares outstanding is our 60,000. So to get your dividends per share, you take the number of dividends that were paid, divide it by the number of shares outstanding, and we paid out 53 cents in dividends per share this year. So if somebody held 2 shares, they would get $1.06 in dividends for this particular year when they were supposed to get $1.20. All right. Our dividends for common shares are 0 because preferred stockholders got all of the dividends this year. So I'm just going to put 0 in here just to keep it straight. So the answer for year 1 would be 53 cents per share for preferred and 0 for common. All right, in year 2, they declared $75,000 in dividends. Again, they're supposed to get paid $36,000 per year. We can now pay our $4,000 from last year because there is enough to absorb that. So let's go ahead and take care of our dividends and arrears. Also pay out our $36,000 in this year. So if you want to use Excel to do your addition here, even though it's pretty simple, you can do that. 40,000. We still have 60,000 shares outstanding. So to get your dividends per share, take your total dividends paid, divide it by the number of shares outstanding to get 67 cents per year. So essentially we're making up for that 7 cents that we didn't pay this year because we only paid 53 cents when we were supposed to pay 60. All right. Common stockholders are going to get whatever is left over. So we declared $75,000 in dividends. We paid out $40,000 to our preferred shareholders. So $35,000 is left over to pay to the common shareholders now. Common shares outstanding are 405,000. So to get our dividends per share, it's the same way you calculate up here, the total dividends divided by the number of shares outstanding. Common shareholders are getting 9 cents per share. All right, year 3, they paid out $100,000 in dividends. Doesn't change. We're still paying out $36,000 to preferred shareholders. We've taken care of the dividends and arrears right now, so we don't have anything. So $36,000 is the amount they're getting this year. Divide that by the 60,000 shares outstanding. We're back to the 60 cents per share. So now they're getting paid the correct amount. This one evened out. We're down to the 60 cents per share. Common shareholders are getting whatever's left over. So we declared $100,000. We paid out $36,000 to our preferred shareholders. So $64,000 is left to pay to the common shareholders. There's still 405,000 shares outstanding. And just divide it out. So your number of dividends they got paid divided by the number of shares outstanding, and it's now 16 cents per share. So you can see it's going up for those common shareholders. So as the company does better and better, they're going to declare more and more dividends. So it's a share of the earnings, and the common shareholders amount will continue to go up. All right, 4th year, 110,000. So you can see it's getting bigger. 36,000 guaranteed to our preferred shareholders every single year. That's the amount that we're paying out. Still 60,000 shares outstanding. So divide it out. Our 36,000 dividends divided by the number of shares outstanding. 60 cents per share. 110,000 dividends declared. Subtract out the amount that you paid to the preferred shareholders. So common shareholders are now getting 74,000. They have 405,000 shares outstanding, and divided out number of dividends paid divided by the number of shares outstanding. They're getting 18 cents per share. So you can see it is going up. It's doubled from year 2 to year 4 now. So as the company continues to do better and better, that will get greater. But if they have a bad year, obviously the common shareholders will suffer more than the preferred shareholders because they are still guaranteed that $36,000 every year. And if they don't get paid it, they'll get paid in the following years. All right, so preferred stock tends to have more characteristics like debt. So just like they make scheduled interest payments, essentially they're making that dividend right payment here of 3%. So very similar characteristics to debt. They're guaranteed an amount, but again, as the company gets, essentially as the company grows, they don't share as much as the common shareholders do. All right, so if you would like to see any additional videos, make sure to comment below. And if you like this video, go ahead and hit the like button. And then subscribe to the channel if you'd like to stay up to date on any videos that I continually add. All right, in the meantime, happy studying.